The biggest opportunity that we see, then the reality is that we're going to see less demand and a tightening of supply.
You're tuning in to The Property Couch, Australia's #1 property, finance and money podcast. Featuring the titans of the industry since 2015, we're trusted by tens of thousands of investors on their journey to financial peace. This show is powered by More.
Thanks, Opti, and welcome to the show. A big show. I'm going deep diving today. We're doing the solo episode, but it is one of our most popular and important episodes. It's our property market outlook episode, and it's going to take a look at all the different data that forms our opinions on the market. Because remember, it's a social science. We're studying economics, is studying human movement, human behaviour around what people do in the marketplace, and that's what we're going to be looking at. So we'll take a look at some of the data and then we'll start to form our views on that and prosecute our case in terms of what's going to happen in different markets. So some of the big themes that we're going to be focusing in on, very much interest rates, tax policy, the state economies, population movement, very important when you're thinking about future demand and supply. In terms of the supply challenges and buyer speculations, I'm going to go a little bit deeper on that in today's show. And then obviously our 2026 capital market predictions. I'm going to talk to you about the pros and cons in each market and then form a view in terms of which markets are going to potentially outperform and which ones aren't. And then if you hang around to the end of the show, I'm also going to be flagging the biggest risk of 2026 and also the biggest opportunities that are available to you as well. All right, so first up, I want to do a bit of scene setting, a bit of housekeeping maybe you might want to call it. And this is for anyone who's new to our show. And I want to just explain to you that there is going to be a fair bit of data. So if you're listening, I'll do my best to explain that data. But if you're watching, there will be several graphs that will talk to our story. And a little tip for those who are also joining us for the first time, in episode 535, which was our market outlook in 2025, and episode 481, which was our market outlook for 2024, inside both of those episodes, you will see us talking, Bryce and I, talking about some of the more important data sets that we look at or that were sort of bubbling to the top as part of what we're looking at that time. If we had our way, this would be a 5-hour episode where we would take an extended look at all the data. But what I've done is I've synthesized that data to basically bring the best information to you and the most important data points for this year as we look at the 2026 outlook. Now, also for our new listeners as well, I want to talk to you about what's been happening around property speculation. There's a lot of interest in property investing at the moment, given the shortage of property. A lot of people think they can make a lot of money out of property. So buyer beware, always make sure that you understand the fundamentals when it comes to short-term versus long-term, and don't be seduced by irrational exuberance that is occurring in some pockets of the market. Bryce and I did talk about that last year as well. So if you do listen to episode 535, you'll get a bit more insight into that. But remember this, that if you have short-term movements, that doesn't fundamentally prosecute the long-term performance of a market. So you can have that irrational exuberance, which is often led by investors, where investors are the one driving the market as opposed to what we've always talked about, which is owner-occupier should be the price maker. They should be driving the market and investors should be the price taker over the long term. Otherwise, you will get this volatility in the market and you will run the risk of seeing those values move beyond their fair value. So that's an important message for all of you beginners out there as well. And finally, when you're talking about the Australian property market, always remember there is no such thing as the Australian property market. There are thousands of sub-markets within the markets. And today, I'm just going to synthesize those down to our big capital cities. I might make some reference to some regional markets as well, but that is the main theme of today's show. So we want to get the signal from the noise, and I'll be talking about the capital cities because property prices usually bleed from the capital cities down and expand into those other markets. So let's get into the show, firstly starting with a recap of 2025. Opti, can you just bring up 2025's episode and just run through the order in terms of our price predictions from last year?
Great question, Ben. Let's rewind to our 2025 property market outlook to hear our state-by-state predictions.
If we were to put them into the buckets, as I said to you, I'll put Darwin in my top two. I believe that Adelaide will come down. They will finally, and Perth's rate of growth will slow down. Queensland, Southeast Queensland will continue to do well, but also so be in that sort of growth bucket. And then the one that will come up is actually Melbourne. So Melbourne is going to come up just off the investor demand from the interstate buyers in terms of that. So we know that a lot of buyers agents are getting on planes and coming down here. So we know that that's creating this heightened level of demand in the short term. So if that was to continue and people start to see growth in Melbourne, then we believe Melbourne will do that. Now, from the fundamentals, we think it's a little early, but again, it's counter-cyclical investing. If you're investing for the long term, what Bryce was saying, then Melbourne should always be an asset that you want to hold in your portfolio. Then you've got Canberra, which is uninvestable. There is just no incentive to invest in Canberra at all. So if you are thinking about the Canberra market, go over the border into Queanbeyan, because obviously that's in New South Wales and you get New South Wales regulations instead of Canberra regulations. There is so many problems with being an investor in that particular market. I won't bore you with them, but you just don't get any return on your investment there. So I've wrapped them up. And Sydney probably in the bottom of the 8. So I've got Sydney in the lower end. I've got Hobart there. I've got Canberra down in that bottom quartile. Then we've got, as I said to you, I've got Darwin as number 1. I've got probably Brisbane and Perth in that sort of fighting for 2 and 3. Then I've got Adelaide coming down and Melbourne coming up in terms of what they look like in there's a, again, these are just predictions. I'm putting my views out there. But to Bryce's point, I'm really thinking about these from a long point of view. If you ask me, if you put me on the spot to give me that ranking, that's what I've just given you in terms of where I see the market. So there you go. We had Darwin as number 1. We got that right. We had Perth and Brisbane. Looking at those two markets, we got those in the right order in terms of in that top cycle of the market. We had Adelaide just underneath of that. So those 4 markets, we had 100% strike rate. In terms of Melbourne, we saw Melbourne did scratch out some growth in 2025, but the reality is it's probably just been flattening down a little bit. We saw Sydney also move a little bit higher, but cool off at the end of last year. And then we had the Hobart and also Canberra markets. Hobart did better than I expected it to be honest, and Canberra also was a little bit flat and sluggish as well. So overall, it was a pretty solid result. But I also want to make sure that you also remember what Bryce gave a great bit of advice. So Opti, can you play Bryce's great bit of advice for us?
Sure thing, Ben. Here's what Bryce said.
If you are playing a game to set up a passive income that provides you a retirement in 5, 10, 15, 20 years from now, I'll go back to the original conversation that I said to you at the very beginning of this podcast is buy the right property, correctly finance and hold it for the long term is still relevant with a property market outlook today as it is in every episode that we talk about.
Thanks, Opti. Now, that's exactly what we try and keep as a message here. As value investors, we're looking to find the right types of property that meet clients' budgets. We're looking to find, obviously, in the right sustainable locations. So that is obviously our capital cities and commutable locations. Or if we do have to go, and this is new, if we do have to go into regional areas, we're looking for the demographic profile to be right, which means we're looking for younger people to be in that particular market as opposed to an older base of people in that market, because if they pass away, that demand for property in those areas is going to decline over the medium to longer term. So we're not looking for places where people go to retire and die. We're looking for places where a lot of young people are also moving into, which creates that economic momentum that's sustainable, and that demand for property is also sustainable in those areas. And of course, yes, right financing. Don't get too seduced by structures and all those types of things. Keep it simple and then hold for the long term. So that just gives you a bit of a wrap in terms of what happened in 2025. Let's now move into our macro assessment of the marketplace in terms of the big economic things that we're looking at before we start going a little bit deeper into the localised property market state by state. So the big themes coming out of the global economy are these, that there is this rise of nationalism, this populism in terms of political populism that's also going on there. And that is having an impact in terms of global trust. So, our friends and partners and neighbours and Western societies, there has been a bit of tension and trust lost with what's going on there. Free trade is being challenged as the focus becomes on localised jobs and localised nationalism that's been obviously led by Donald Trump, and also the trade tariffs that he's introduced as part of that. So we've got to keep that in mind in terms of this, this unease. But at the moment, everyone's getting a little bit more accepting of this sort of variety of changes that are happening. We're not seeing as many spikes or reactive natures associated with those, especially after Donald Trump's first round of tariffs got knocked out by their Supreme Court. And so we're basically seeing the equity markets not respond as much to his proposal of 15% tariffs. So we don't see any sort of major problems there. Our baseline assumptions are these: US global tariffs continue to break and slow global growth. We're hopeful of no escalations in the existing conflicts that we have going around the world. That also means that we don't hope that US attacks Iran. That will cause some significant concerns, and obviously in terms of economic confidence, and slow down sentiment. And then, of course, China and US relationships, we hope that they are managed successfully and they don't escalate into further tensions. In terms of some of our derailers that might see some downward pressure on our forecasts, that is, again, any war escalations. EU and US relations sour a bit further, and then AI advancements come a little bit quicker, and that destabilises jobs and employment around the globe. So generally speaking, if we have the same status quo as what we've got now, our known knowns, so to speak, that will be part of our thesis around the global economy not having an impact in terms of the local economy. Let's now turn to the local economy. Let's now focus in on the inflation story. So we can see here that core inflation, so we've done our analysis in terms of core inflation has moved away from the band, and that's obviously causing pressure in terms of interest rates. So we can see here consensus forecast has the cash rate moving and core inflation moving outside of that, and that's going to force the RBA's hand to increase another interest rate movement. We have forecast for May and a potential second one later in the year. So that inflation will be pushing, the sort of interest rates higher, the cash rate higher, and that's going to have a negative impact on sentiment. So sentiment, again, at the end of the day, the science of human economics is the science of people and what their behaviours are. So that will have an impact on sentiment. It'll also, the news stories will be going out there. We'll have cost of living challenges as part of that particular story. And that naturally has a negative downward impact on housing demand. Our baseline assessment, as I said a moment ago, is one additional rate rise in May and hopefully holding out. But the derailer would be that if we do get a second rate rise in the second half of the year because inflation is still outside that target range, then we're probably going to see a slower price growth movement right across the market as part of that particular story. So when we turn to the broader local domestic economic outlook, we can see here again in our forecasts around where GDP is going, the economy has run hotter than the RBA had forecast, and that's part of this inflation story. And so given that, we've seen record levels of government spending that has sort of driven that strong economy. That's seen strong employment numbers. And of course, our baby boomers getting access to their super are also enjoying themselves and spending as well during this time. Now, our baseline assessment for the economy is that it will slow off the back of higher interest rates. We'll see higher living costs. Our challenges and focus are on energy costs, general housing construction costs, health and insurance costs. If they start to blow out, we're going to see some real concerns there. We will see less government spending, but they're still spending very, very heavily at the moment. So that is putting in a base load of spending in the economy. Some of their spending promises are now baked in. They're not one-off. But of course, off the back of higher interest rates, we'll start to see that unemployment story start to move higher. We'll talk about that data in a second. It's a good segue into, what we think around that in terms of that unemployment story. So you can see our forecast here, and in terms of sentiment consensus, 4.4% moving to 4.5%. So moving the unemployment rate from around 4.1 to 4.4, 4.5, and that will obviously do the job of that. The obviously unknown here is in terms of AI and productivity and what businesses do around the implementation of agents and those types of things. We don't expect to see that too quickly in Australia. We are seeing it over in the US, but we don't see it moving as quick here. But we do think that that's got to be something you've got to be factoring in over the next 3 to 5 years in terms of what happens with employment and then how that impacts the overall economy. Right, the other big theme that we want to look at from a thematics point of view is consumer sentiment. So this is where we do focus on the Westpac and Melbourne Institute's data that comes out. A couple of big things here. Broader consumer sentiment has dropped off the back of higher interest rates in the latest data that hit the markets in February, earlier this month. We think in terms of the broader macro sentiment will be a little bit softer. We've got unemployment expectations remain positive. Now that is a good underlying sort of message that people will probably continue to keep spending because they have job security. So if that turns in terms of that sentiment around job security, then that's going to impact negatively in terms of what happens to the broader property market. The other sort of superpower that the property market has is this underlying belief that house price expectations, look at that reading there, 173.9, so that's up 22.2%. So what is that saying? It basically says that everyone in Australia thinks property prices are just going to keep growing. All right, and now even though time to buy a dwelling has come off and is now negative because of higher interest rates, the reality is that people still believe that house prices are going to keep growing higher and higher. So that is something to understand. And then when you think about some of the judgments that people are going to make about waiting or acting, when you've got the 5% government guarantee, that has absolutely increased the number of pressure in terms of from a demand. So that's a positive story in terms of our sentiment and assessment around property. And we've also got limited supply. We've got this driving demand from first home buyers, and we've still got pretty solid population growth. So that is, sort of helping us with our overall assessment of the macro conditions in the market. So as we're judging it, we still think that tight supply and these underlying demand drivers more broadly means that the property market is going to be fairly well supported in the 2026 calendar year. Now, let's take a closer look into the state-by-state areas. And let's start with CommSec's the state of the states. This is an excellent little metric that you can use to help you get a sense of economic growth, household spending, equipment investment, employment growth, construction work, population growth, housing finance, and dwelling starts. So we can see that there is, some of our more popular and active markets, strong housing starts in Northern Territory, WA, and also South Australia. So off the back of that, but then you've got Queensland, the housing starts are really struggling. Victoria, they're struggling. New South Wales has double-digit numbers there. And the ACT, that's anemic. So, off the back of those dwelling starts, that supply coming on. So we will see some of that supply starting to arrive in some of those markets. Now, more broadly, when we assess this, we take a look at, what's changed over the last 12 months in terms of the rankings. So we can still see that WA is ranked number 1 in terms of the strength of their economy. They've got lots of positive things going for them. We said that last year, and that's why we made the base case that the property market will do very well over there. We see Queensland is now a clear number 2, and then Adelaide's dropped to number 3. And the other big mover there, we've seen obviously Melbourne and Victoria fall backwards off the back of the economic management or the poor economic management that we're seeing here in Victoria. And so that's a problem for Victoria. And then obviously we can see New South Wales ranking 7, ACT ranking 8, the Tasmania ranking 6 as well. So let's go around that. WA number 1, Queensland number 2, South Australia number 3, Northern Territory number 4. A lot of infrastructure investment going on there. Number 5, Victoria, still off the back of the big build and government spending, but that's going to come off. So the challenges are the economy in Victoria. Number 6 is Tasmania. Number 7 is New South Wales. And number 8 is the ACT, as judged by the state of the states, looking at those key metrics that they measure for that particular market. Okay, let's now turn our attentions to breaking down population movement. This is very, very critical for both demand and supply metrics. So if demand arrives, i.e. population arrives, at some point that population is going to be interested in potentially, putting roots down in that particular location, and that's going to be demand for property. And of course, if they're arriving, it's immediate demand from a rental perspective as well. So what we can see here is the changes. So in terms of population growth is cooling, and we'll have a look at immigration in a minute, but here's the big story here. So we can see net overseas migration. The numbers are still obviously coming into the big population centres of New South Wales and Victoria. It is Victoria's superpower at the moment, in addition to the natural increase, whereas what we're seeing in New South Wales is net interstate migration is declining. So they're usually moving to Queensland, and then you see the Queensland story there. They've got ticks across the board. They've got natural increase, they've got net interstate migration, and they've also got net overseas migration. So that is a core driver for Queensland's story. South Australia, not a lot of natural increase. You've got net interstate migration, so no one's really moving there locally, but you do have some overseas net migration into that market. WA, again, same as Queensland, really strong natural increase, really strong net interstate migration, and also net overseas migration. And again, when you look at this on a per capita basis, WA is a clear winner in terms of population growth. And then you can see Tasmania, almost neutral population growth. So that's a challenge for that particular market. Also the Northern Territory, in terms of losing more net interstate migration. They've got a little bit of natural increase and a little bit of net overseas migration, but that's a speculative market. That's being driven by investors in terms of its price performance at the moment. And then the ACT, the same sort of thing, really off a small base, but we're seeing some net overseas migration, but we're seeing net interstate migration, so people leaving there more than arriving there, but we do have a natural increase in that particular market. Now, I promised to also then highlight what's happening in terms of the overseas immigration, and we can see here that we had an enormous spike in 2023, a solid 2024, 25 is looking at like 306,000, and then we're seeing that forecast come off to 260 and 225. Now, the governments have got these forecasts wrong in the past, and the likelihood if they do get them wrong is on the upside rather than the downside, unless we see migration policy change significantly. We're still seeing, again, around 250,000 people coming into the Australian market looking for housing over the course of the next 12 months. So 260,000 and then another 225,000 forecast in 2027. All right, so I thought now is a good time to probably just summarise some of those macros assumptions that I just did in terms of the property impacts. And I want to talk to them in positive and negative context in terms of how they would look, so you can get an understanding of our base case line here. So in terms of short-term positive demand impacts on property prices, continued tight supply, which is a factor of red tape, labour shortages and building costs, are going to see supply being constrained. And I'm going to take a bit more of a deeper dive into that in a couple of minutes' time. In terms of continued population growth, that is also a good sign for pressure, upward pressure on property prices more generally. Government incentives such as the 5% deposit guarantee and also the state first home buyers guarantees, etc., and incentives are also indicators and incentives to drive demand in the short term. Investor demand due to tight housing and rental supply is providing that opportunity. So there is a lot of investors moving into the market now. We can see that in the finance data, more than we would normally like to see. So there's a little bit of speculation or opportunism that's happening, but at the end of the day, that's driving demand, and that's going to have upward pressure on property prices. The economy generally is performing okay off the back of all the government spending that we need and have seen, and that's keeping employment holding up. So what we need to see from an investment point of view is private investment and businesses still holding strong sentiment, and we'll see that play out throughout the course of the year. In terms of short-term negative impacts on property prices, and this one is the big one. Actually, there's two. I'll start with inflation and higher interest rates. So that obviously tapers demand from owner-occupiers and investors because it reduces borrowing power and takes less pressure in terms of overall turnover in the market if people can't afford to get into the market. The other one is obviously, rising unemployment, which is reducing demand. So we will see a little bit of that off the back of the RBA's movements on interest rates and lending restrictions. So we saw APRA last year flag debt to income service ratios, and we'll potentially see, I think, a little bit more throttling if they feel like the number of investors who are getting into the market continue. Now, fortunately, some of the lenders last year, when we flagged to them around trust and self-managed super fund lending, have tightened up their lending policy. So low doc and no doc lending that was happening in that space was a real catalyst for some animal frenzies that we saw and some speculation and trading in the market. Hopefully, reducing the access to that trust lending has taken a little bit of heat out of that in terms of what's happening more broadly. Now, here's some further upside benefit that might come into the market depending on government settings. And that is immigration numbers will overshoot, like what I said before, because we've got a lot of students and so forth, international students potentially arriving in the country. They get their short-term visas, and with those work shortages visas, those people try and then get permanent residency off the back of that. So there's still a chance that we'll see population increase on the upside. And then, of course, further government building incentives to stimulate demand and supply. We might see something like that in the May budget. That could give upside benefit in terms of short-term house prices. Now let's focus on the downside risk. So this is not part of our base case assessment, but these could be real things that could hamper future price growth in the short term. The first one is what I mentioned before, APRA doing some throttling changes in terms of allowing access to lending, and then also ASIC regulations that could also be coming to the market, and enforcement. So we know that there's surveillance potentially going on in this property investment advice space, and also in this, lead generation marketing and, spruikers and buyers agents, promoting get rich quick opportunities inside property. So there could be some ASIC enforcement that could scare off a little bit of that activity, and that might flow on to the consumer. Now, in the May budget, this is the big one. This is the big one, and I'll talk more about it later on when I talk about the risk. And that's it. This is reform to capital gains tax. So we have fairly strong indications that Labor will look at capital gains tax reform. And just as a side note, I'm doing a very special deep dive on this particular topic. It's going to be released in terms of social media, but we'll also add it as a bonus episode on a Tuesday, next Tuesday's episode. That episode will focus where I'll go deep on capital gains tax. More further downside risk could come from a slowing economy and increasing unemployment that I talked about, and then government interference, in terms of higher government taxes, both at a state and federal level, i.e. land tax. Any rental reforms that might come in to throttle rental growth could also have some downside risk. It'll also tighten supply, so it has a dual benefit and negative in that respect. Changes to the immigration policy I mentioned before, and compliance and insurance blowout cost to run our private rental accommodation businesses. If it's costing us more to run those, it may deter people in terms of the future returns and passive income that they're going to get in residential property, and so they might take their investment dollars elsewhere. So I wanted to do that summary now before we then start to move in and take a deeper look at what's happening at a capital city by capital city level. Rightio, so now we're getting into the nuts and bolts of supply and demand, because they obviously move property prices in the short term, and it's economic activity, human interest and human behaviour that sustain that over the long term. But I'm not sure whether many people have been reporting this, but it is a critical point, and I mentioned a couple of minutes ago I wanted to go deeper on this. And this is from the Statement of Monetary Policy, which is the RBA's forecast that comes out. Now, this helps us understand how the RBA is thinking about the market. And there was a particular data point in here that is something that every investor should understand, and that is in respect of dwelling investment. So in the near term dwelling investment, in the previous Statement of Monetary Policy forecast, they had private dwelling investment growing at 3 to 3.7%. Right, so that's very healthy, right? That's a really healthy clip. The latest forecast, they only have dwelling investment growing at 0.3%. That is a red flag, people. Understand that what the RBA is saying based on their data is when interest rates start to go up, dwelling investment starts to go down. But it's also giving us a little bit of a signal in potentially they're thinking about interest rates. Like with just one interest rate increase, I don't think that forecast would be 0.3. But if there's another interest rate coming in May and potentially a third interest rate increase in later in the year, that 0.3 makes a lot of sense to me. So that is going to have a significant impact when it comes to demand and potentially also future supply. And it's the supply story here that's the big one. If we're going to see dwelling investments decline significantly, we're going to have a very, very tight property market, and tight property markets usually lead to price growth above all else when you think about indicators in the general market. So just remember that if we're going to see further interest rate rises, we're just not going to see that supply, that new supply, come into market anytime soon. So thanks to our good friends at Cotality, let's take a look at their data around capital city population listings. So Sydney, new listings that have come on in the last 4 weeks is up 6.8%, but overall listings from 12 months ago is down negative 5.8%. Melbourne's had a really strong start to the year with 17.5% increase in new listings, but overall listings are still down from 12 months ago by around 4%. In terms of Brisbane, we can see that listings are down 8.5% in the last 4 weeks, but also down 22.9% in terms of the last 12 months. So that's why we're seeing strong price growth in Brisbane right now. Adelaide, 1.5% new listings, down still 5.5% over the year, and we still see that market scratching out month-on-month increases. Perth, this is the big story. Strong economics, population growth moving there, high rental yields. We're seeing still, in terms of new listings in the last 4 weeks, 13.8% down. Overall, 35% down in terms of stock on market, new listings in the last 12 months. So that bodes well for strong price growth, at least in the early half of 2026 for Perth. In terms of Hobart, we saw a 3.4% increase in new listings in the last 4 weeks compared to 12 months ago. And then the overall 12-month number for Hobart. And then we saw the overall stock supply down almost 28%. So that bodes well for Hobart in terms of its stock levels, in terms of keeping prices where they are, or potentially seeing some price growth in the Hobart market. Darwin, again, through just the sheer number of new activity that's going on up there, new listings down 22% and overall supply down 37.5%. So again, bodes well for Darwin's prospects. It's certainly in the first 6 months of this year. Canberra, on the other hand, we saw 18.4% increase in listings, new listings in that market, and stock levels down only 4.4% as part of that rounding out those capital city markets. So we can see from that in reality, we've got still the big three, big four where price pressures and momentum and sentiment are kicking forward, which is the Perth market, the Darwin market, the Brisbane and Adelaide markets as part of that story. But Adelaide starting to fall out of that group as part of that particular story, and then the others making up the difference at the bottom. So listings is one part of the supply story that we need to understand, but the other part of the supply story is the approvals that are coming through. And we can see here again, thanks to our friends at Cotality and using the ABS data, we can see in terms of housing approvals nationally that we've got housing approvals moving in an upward direction, pretty much led by first home buyers, so that's a good story. But where the problem still exists is in regards to the medium and high density construction area. In terms of the long-term decade average, we can see that sort of falling below that number. So that still, again, says we've got challenges when it comes to shovel ready and getting new stock and supply out of the market, which ultimately leads to a tighter supply market. From an investor's perspective, we also want to study the rents in terms of what's happening around vacancy rates and supply in the rental market. So again, let's take a look at the data. Thanks to our good friends at Cotality, we can see here that in terms of the last new listings over the last 4 weeks for the last 12 months is down almost 10%. In Sydney, overall down around 21%. In terms of Melbourne, down around 4% in the new listings and overall down around 13 to 14%. Brisbane, off the back of potentially a lot of investor activity, we're starting to see new listings 3.2% in that particular market, but overall still down around 12%. Then Adelaide, we're seeing an increase in new listings of rental properties, 7.5% in the last 4 weeks, and that's their overall total market is still sitting around 9% below where it was 12 months ago. Perth, again, the super challenge market, we're seeing less listings, 3.9%. So the real driver in Perth at the moment is the owner-occupier. They are coming in strong. First home buyers are coming in strong over there. So a lot of the investors left thinking that they've made their money in the sort of last 2 years before 2026, but now it's really underpinned by that owner-occupier demand. That's why it's a really strong market in my opinion. So down by 4% in terms of new listings over the last 4 weeks and down almost 17% over this time last year. Hobart sitting pretty flat in terms of new listings, but still down around 6% on the year before. Darwin, again, with all of these investors coming into that market, we're seeing a spike in the number of properties available for rent because it's being investor driven, but still in terms of the last 12 months, around 14% below where it was last year. Canberra, we're seeing negative almost 9% of new listings and down 17%, so really tight rental market in Canberra. A pity that all of your rental income goes to the government in land tax, so that's a problem for that particular market. But we can see when we look at that in terms of vacancy rates, we are starting to see those markets all move into sub 1% or around that 1.2% when we're looking at those vacancy rates. So from an investor's point of view, and why investors are happily active in the market is that tight supply, that tight rental supply means that they're coming into the markets, and we would expect to see in terms of fairly solid rental growth over the course of the next 12 months. So let's now turn our attention to the demand equation in terms of the demand forces that are also moving the market. And this is a really good chart. I mean, I could do so many different charts here. I could spend hours, but I thought I'd just highlight this one here, which is the days on market. And so we can see the days on market that's coming through and reducing. And obviously, if you're looking at the chart through a video connection, you can see that big number, that big correction in terms of the days on market is the Darwin market. But you can still see Darwin now settling in, and you've got Canberra still settling in around that sort of 40, 45 day area. But those other markets, the days on markets, are still looking quite tight. And you can see here when we look at Cotality's numbers, this is a really good indicator in terms of the directional. We're looking at sort of some of the signals in the noise, and we can see directionally there when we look at Canberra, Darwin, Hobart, Perth, Adelaide, Brisbane, Melbourne, and Sydney, that they're all shorter days on market than what we saw in 2025. So again, bodes well for price pressure, upward pressure on prices in at least the first half of this year, if that is going to continue to be a tight market. And we're seeing, in terms of the initial auction clearance rates, started strongly but are starting to ease off a little bit. So depends on where that momentum will continue on. When we turn our attentions to the rental market, we can see that rents are consistently growing off the back of that tight supply, but also off the back of the holding costs. So don't just think that rents go up just because they can. When you start to introduce higher compliance costs, you start to see higher insurance premiums, and you start to see higher interest rates, rents are going to naturally move higher. And I would expect that that would be a theme throughout the course of 2026. When we look at rental yields across the country, we can see there in terms of from the Cotality data, we've got still strong rental yields in Darwin. We've got strong rental yields in Hobart, Perth. Adelaide's come off because of the strong growth in prices. Brisbane is also pretty strong in terms of the annual change of rent. Melbourne has been pretty soft in real terms, and I made a case for that in terms of the government being anti-investor down in the Melbourne market. But I do suspect that will be the stronger performer in the next 12 months. And if you do have property in the Victorian or Melbourne rental markets, we are advocating for a 4 to 5% minimum increase in rents in that particular market, given the current costs and the higher land tax that's being paid. That's the unintended consequences of government policy when you increase the operating costs of running a small private rental accommodation business. This is going to occur. We will see still a lot of investors looking at the attractive yields in the Darwin market and also the attractive yields in the WA market. The yields are coming down in both Queensland, especially the Brisbane market, as part of that story. But yep, rents are going to continue to keep growing, and that is also going to be a pressure on inflation as well, given rents do make up a good portion of the CPI basket. So in the interest of moving this along, we've now come to the predictions in terms of the different markets, and I'm going to give you some base cases in terms of what's going to happen in those particular markets off these economic fundamentals and the data that we're seeing. So we'll start with the biggest capital city forecast. We're seeing here that price growth, we think it'll be less than 5%, and this is off the back of some interest rate increases. There will be some demand that drives first home buyers into that market thanks to the 5% deposit scheme, but affordability and borrowing power challenges will see that market not necessarily shine in terms of overall growth off the back of that. And of course, the population risk around affordability and seeing an exodus towards the Queensland state is going to keep Sydney prices somewhat challenged, but we think they'll still scratch out a positive result depending on, the caveat here is obviously the capital gains tax reform, which I'll talk about in a minute. Summarising Sydney, we're talking about small growth over the course of the next 12 months. In terms of Melbourne, we do see modest price growth also happening in Melbourne. It could pop a little bit more than that if sentiment starts to move again towards Melbourne in regards to its comparison to other capital cities. There is a difference there, and I've got a bit more to add later. Its superpower is its population growth driver. It's definitely one of the fastest growing first home buyer markets in the country. So that's helping it in terms of demand coming from owner occupiers, not necessarily coming from investors. Price growth is being driven again by that owner occupier demand and not so much investor speculation. Rents, I said earlier, could comfortably lift by 4 to 5%, my bad, in terms of that. And then in terms of the drag on the Melbourne economy is still the state corrupt government, and the debt levels is going to be a major drag on the economy there. So, but if we can get a longer term view on that, Melbourne will be able to scratch out positive result in this calendar year. In terms of Brisbane, we do see further price growth in the Brisbane market, but off the back of potentially 2 rate cuts, we would see that sentiment start to slow and the momentum in that market starting to come off a little bit. Right now it's still off to the races, still very strong. Days on market, all the indicators are leading that is a solid market, but at some point that cycle is going to turn, and we suspect that that's going to turn in the second half of the year. So we'll see potentially solid price growth in the first half, but then settling down in the second half. So potentially in the ranges of 5 to 10% growth over the course of the next 12 months. Other things to note there, the X factor is going to be capital gains tax in terms of taking the investor out of the market, because we're seeing a lot of owner-occupier and investor activity, but predominantly outweighed investor activity in that Brisbane market. Moving along to our Adelaide market, we can see here that we do expect further price growth. The economy is being well managed. They've got stable government. They've got a smart leader in their government who's all about economic growth. That's going to underpin that. But we are starting to see affordability is starting to bite, and that will soften that price growth story, and that affordability story will also start to soften in the southeast Queensland market as well, if I was to overlay that as well. Supply is coming online, so that will obviously ease off, hopefully a little bit of pressure there as well. The 5% deposit scheme is a boon for that Adelaide market. We'll see that sort of driving demand in that area. And then in terms of price growth, has been driven by investors, so there is some owner-occupier demand activity, and so that's why we do think that the Adelaide market is well supported, but we're just not going to see that sort of price growth that they've enjoyed really over the last 5 years. It's been a solid run for that Adelaide market, so we expect that to ease off. Perth, the imbalance between supply and demand remains significant in 2026. Now that will lead to further solid price growth, because it really is also owner-occupier led. Strong economy, the strongest in the country, so that's why we say there's still some more upside in terms of that. It's outperforming on population growth. Consumer spending and investment spending is up. The economy is firing in the west. In terms of, they will still continue to have that severe housing shortage and rental shortage, which will be a positive for investors to go over into there. And of course, putting fuel on the fire is that 5% deposit scheme for first home buyers over in that market. So we do think with that, owner-occupied led demand, that the Perth market is also going to be a very strong market, at least in the first half of this calendar year and potentially moving into the second half. In terms of Darwin, good news story for Darwin is they've got a really good government in play who is pro-business and pro-investment, and they've got a nice pipeline of infrastructure that is lined up. So that is a positive. But Darwin, make no mistake, is a boom-bust market, and the current cycle will continue to keep booming inside 2026, but it's a market that can also correct and collapse reasonably quickly. So timing the market in Darwin becomes a real positive if you can do it, because this property speculation and property speculators who are driving the bulk of the price increases in that market, when that sentiment shifts, that's when we're going to see, who's been swimming naked when the tide goes out. So that is an important message for that Darwin market as well. So keep an eye on Darwin. We still think very strong growth, top three, but in terms of what happens after that, or will there be a sentiment shift quickly and then people getting stuck in terms of coming into that market late. Let's focus on Hobart now. We still see a steady ship, and they'll scratch out some price growth in 2026. The state government is unstable. Their political environment is unstable in terms of minority governments and so forth, but they need to continue to keep focusing on investment. The big challenge that they do have is they still are a really small country town in terms of, compared to obviously bigger population centres. Both Darwin and Hobart don't fit into our top 13 population centres around the country, so that just gives you some context in terms of that particular market. Their Achilles heel is population movement. So, with basically stagnant population growth, that's going to be a challenge for them. And with that older population potentially dying off over the next 3 to 5 years, that's what you've got to worry about in terms of whether there is enough supply in that market. Some of the positives is potentially, their new stadium, international stadium, that's going to come in and drive economic investment and growth down there as part of the AFL initiative and other other sporting activities that drive economic growth and activity. But in a broader sense, Hobart is a watch and hold, but it should see some slight growth. In terms of the Canberra market, rounding it out, you've heard me say this before if you've listened to these before, but I'm sorry, it's not an investment market that we would support. You're crazy going into the Canberra market to invest. The state government land tax in that particular market is chronic. So unless they change those settings, you're just collecting rent and giving it to the government when it comes to owning freestanding properties in that market. You could, guess to go into the investor apartment market, but there's always that risk of chronic oversupply at some point in the future. So we would always say avoid the Canberra market. If you are looking at opportunities in that market, buy on the New South Wales border side where you're not restricted by the silly government settings that they have there. And of course, rents will continue to keep growing because there will be a shortage in that Canberra market. But that really is led by owner-occupier demand, and the government's swelling in that particular market as well. So at some point in the future, there'll probably be a correction in the number of employees in government that we see in the Canberra bubble. So from that point of view, I'd always be careful. So at the start of the show, I said we're going to focus on what the biggest risk is, and we're at that point now. And it's really clear to me that the government, the federal government, will introduce, and this is a prediction that I'm making that will change what I've just said, but if they do introduce capital gains tax reform, then the reality is that we're going to see less demand and a tightening of supply in the market. Now, if we balance all of those things up, what we don't know, and this is why I didn't add it to my broader forecast, is the policy settings. So let's just take a look at the animal spirits that are occurring in the property market by looking at the investor lending activity. So you can see here in this chart, if you're watching, the 10-year average. So you can see the 10-year average versus what's happening recently in ACT feels about right. Northern Territory, the 10-year average compared to the amount of investor activity is off the charts. All right, so that's where the danger lives because there's too much speculation. Tassie feels about right. WA, it's still got a healthy level of investor activity, and you can see that in terms of, but from a long-term point of view, it still feels a little bit overweighted in the number of investors in there. But again, I've got comfort in the number of owner-occupiers and first-home buyers active in that market. South Australia has also overshot in terms of investor activity, as has Queensland. Victoria, as I said, it's a little bit more anemic on the investor front because of the anti-government settings that we've got here around investment activity. New South Wales also, its 10-year average is quite astonishing in terms of where it sits with the number of investor lending into that particular market, but still 46% of lender activity in New South Wales is investor. That's unsustainable. So the government are going to want to level the playing field. They're going to talk to you about inequality, in terms of housing inequity and inequalities, intergenerational inequalities. And I promised earlier that I'm going to do a special on this, and so tune into that next Tuesday if you haven't already seen it on socials. But the tax reform and this policy is going to make the trading of property. So if anyone's been talking to you about, rent vesting and turning properties over and trading them, this is problematic for your situation, especially depending on the settings that they have. So if they adopt a simple setting of a 50% increase on tax and you were planning to trade your way through properties to build wealth, well, you're going to be paying an extra 50% of that gain to the government. So that strategy has been poorly advised to you as part of that. If you've got a long-term strategy with a long-term focus, hopefully it won't be as much of an impact. But that is by far the biggest risk, and we'll start to see more on that politically over the course of the coming weeks and months as we lead into the May budget. Finally, in terms of the biggest opportunity, I wanted to focus in on the counter-cyclical story of the market, and that purely points directionally towards Melbourne in terms of a market that has clearly underperformed over the last 3 to 5 years. And when you are looking at a market like this, you want to lift your eyes up. So in the short term, Melbourne again will scratch out growth in 2026. But if that sentiment moves in the direction that we know it will, which is over time, buyers will start to think counter-cyclical and start to think, well, if I'm investing for the long term, and if I take a look at the state government production, so have a look at different gross state production, have a look at the New South Wales, obviously our biggest economy, Victoria, our second biggest economy, and then you look at Queensland and Western Australia as the two underneath that. And then really you can just now get the context of just how small some of our other capital cities' economies are. You want to be in these bigger markets. And what better time to buy in the bigger markets when everyone else is fearful? I mean, that's the whole idea of value investing. And if we have then a look at the gross regional production by our capital cities, you can see there, now this is obviously what we call a smooth illustratively series in terms of the linear line that you're looking at there. But from 2000 to 2000 and basically 24, 25, we can see there that the capital city in terms of city gross regional product, which is based on ABS data, that Sydney, it produces a lot of our economic engine, followed by Melbourne. And then you can see the clear differentiation between both Brisbane and also Perth. And that's why in terms of the biggest opportunity that we see in the market, in terms of if you're not just thinking for the next 12 months, but you're thinking for the next 5 to 10 years, then Melbourne might be that opportunity for you if you don't have assets already in the Melbourne market. It is one of those things. Now, the caveat that I'll put on this, because there's always downside risk as well. Labor's economic management either needs to improve or they need to lose the next state election, which is in November, because the failing economy is dampening demand growth. And if you are buying in Melbourne, again, I would say take that counter-cyclical view and that medium to longer term view in terms of what that looks like. Because the reality is that Melbourne property prices should, if you measure it against economic activity, regression to the mean, should start to improve up into that higher area and regain its footing as the second most expensive market in the country based off that economic activity. So there is a buying opportunity in Melbourne. So that wraps up the round the grounds in terms of our capital cities. But again, I wanted to talk also about what's going to happen in the regional markets and the more affordable markets, because we still see 2026 as being a market where we're going to see more price pressure on the entry-level markets off the back of a lot of investment speculation. And it's also, we can't just talk about that. We've got to talk about what investors can afford. So if they can only afford a certain amount of borrowing capacity, that is going to drive them into those affordable markets. Now, at the moment, it's very hard to see housing in terms of houses or even semis, and in some cases, townhouses, being affordable in those big capital city markets. So an investor is potentially making a decision, do they go and try and buy a freestanding house in a regional market, or do they substitute out the freestanding market and go to townhouse or what we call a villa unit, or then into a small apartment block? And so that is going to be debated heavily in terms of what's going to happen. In the bigger capital markets, we're starting to see that trend where people want to stay in the capital cities, but in terms of where the speculation is at, is going into those regional markets and driving up those prices, because it's all about finding property in a price range where those buyers agents can turn over property and get artificially inflated property prices. So my tip for regional market is, yes, it will be a strong regional market off the back of that, subject to the capital gains reforms, and see what, if that takes the wind out of the sails of these speculators. But if you are going to be looking into those markets, please remember long-term returns, not short-term speculation. So if you are thinking about regional markets or really small towns that aren't within a commutable distance to a major employment centre, you do run the risk of being, forced into a market that might have short-term speculative growth, but the fundamentals don't underpin the long-term fair value, and so you'll see a price correction in those particular markets. So regional markets, yes, an uplift all off the back of the affordability story and investor demand, so be careful there. If you're talking about those commutable markets, the Geelongs, the Ballarats, the Wollongongs, the Newcastles, the southeast Queensland pockets, you can certainly start to make a case for that. Over in the west, your Bunburys, your Mandurahs, those types of markets also will perform very well in the short term off the back of not only the speculators coming in there, but just generally in terms of some of their economic drivers because they're connected to a major capital city. So be careful out there in terms of what you're investing in. And if I can remind everyone before you make any investment decision that you should always seek professional advice. We're giving you some guidance here in terms of the signal in the noise. But if you also want to do really smart research, we have free property market reports and they are available through our More platform. You can download them and you can get multiple data sets in regards to demographics, in regards to demand and supply, scores in relation to days on market, stock on market, average discounts, vendor discounts. All of those things are built into that, and you can start to frame up your knowledge when it comes to investing. So they're available on the More platform. You can get them on your mobile device by downloading the app in the App Store, either Android or iOS, or you can go to the web version and create your account there and also get unlimited free property reports at the moment. So take advantage of those if you want to start to do more research and start to form an opinion in terms of, because we said earlier, macro markets, but thousands of sub-markets. So if you are looking from a macro down into the micro, you do need to get those property reports in your hands. So why not grab access to those? We do make them free so you don't make a serious mistake when it comes to investing in property. But think medium to longer term, don't think short term. So that's a wrap for the 2026 property market outlook. I hope you've enjoyed it. Please give us some feedback. If you've got views in terms of which markets are going to perform well, why don't you put them in the comments below in terms of adding to the conversation and prosecute your argument, understanding your variables, your data points, your fundamentals as to which market you think might do best in 2026. We'll do an update. We'll check in on this in the mid-year, in the August Outlook update as part of that. But hopefully you enjoyed it. And I always say, remember, knowledge is empowering, but only if you act on it. Good luck for your investing in 2026.
Hey folks, Opti here, your smart money sidekick inside More. Just one quick thing before we sign off. If you're new to the Property Couch community, welcome. One quick tip to help you get the most value from the show. Our first 20 episodes cover the foundations we build on every week. And yes, listening on 1.5 speed is totally acceptable. If you're short on time, download our free binge guide. It distills those episodes into one easy read with heaps of visual diagrams, alongside free tools inside More, your all-in-one financial home, to help you organize your money and plan your next best move. Check out all the links in our show description. And just a quick reminder before you go, anything we cover on this podcast is general in nature. It's not considered to be financial advice, and we certainly recommend that you seek out professional advice before making any financial decisions. Once again, everything mentioned is linked in the show description. Ready when you are. Catch you next week.